Good day everyone, and welcome to our webinar for June 2022. The past month has seen a substantial increase in the systematic risk in the share market. Now, investors usually do not pay sufficient attention to systematic risk. They're usually too busy looking for winning shares, and they're not really looking at what is happening to the market as a whole. But it's important to understand that in a bull market, 80% of the shares are rising and 20% are falling. So you can buy pretty much any share that you want. If you make a mistake, the market will come to rescue you. In a bear market, of course, 80% of shares are falling. So you should be out and you should be in cash. But unfortunately, nobody rings a bell at the top of the market. So I'd like to spend a little bit of time talking about how you cope with risk in this situation. There are two types of risk which face private investors. Unsystematic risk, which is the risk which is inherent in the share which you choose. It's the risk that the share that you've chosen will fall. And then there's systematic risk, which is the risk that the entire market falls and takes the shares that you have in your portfolio down with it. Systematic risk is difficult to assess because it depends on the mass psychology of international investors. But some ideas are consistently true and can help you to make correct assessments. For example, in the market, nothing moves in a straight line. This is an axiomatic truth. Always there are corrections within upward trends and rallies within downward trends. In November 2021, in the confidential report, we predicted that the correction which is now taking place. We predicted the correction on the S&P 500 2 months before it began. We said a major correction of between 10 and 20% was imminent, and that we saw the S&P could fall as low as 3860. On the 19th of May, a couple of weeks ago, it fell as low as 3,900, which is within 1% of that level that we predicted. At the time, we said that this would just be a correction. In other words, it would not be the start of a bear trend, and therefore it would present a buying opportunity. Predictions like this are always tenuous. There's always a variable probability of being right. You're always exposed to risk, and therefore it's very important for you to have a strict stop-loss strategy, especially during a time when the market is correcting. If you're unsure about stop-loss strategy, you should go back and read Module 12 in our lecture notes. A stop-loss strategy limits the losses on share investments to a fixed percentage. For example, I never lose more than 15% on any share market investment ever, and that includes my dealing costs. So my stops are never set more than 12% out. The logic is simple. If you choose 10 shares at random, then 5 should beat the index, and 5 will go down. This must be true because the index is an average of the shares from which you are selecting. Now, on those which go up, you can make 100%, 200%, or 300% or more. But on those that go down, if you limit your losses at 15%, then you must be successful. So a strict stop-loss strategy provides you with the confidence that you will be successful. Success, if you apply a stop-loss strategy, is a mathematical certainty. But the hardest thing to do in the market and in life is to admit that you've made a mistake. The last thing to die in the share market is hope. Selling at your stop is a candid admission that you have made a mistake, either in the share you selected, or in your transaction timing, or both. The ability to acknowledge your mistakes is critical to your success in the share market. Indeed, Success is not so much about making money as it is about not losing it. The most dangerous time in an investment is when you are out of the money. That is the time between buying the share, when you buy the share, and when your stop loss level rises above the price that you paid. For example, if you buy a share for 1,000 cents and set a stop loss of 10%, so you set your stop at 900, then you will be out of the money until the share rises to until 1,112 cents. Because at 1,112 cents, you have to deduct 111 cents for your stop loss, because that's 10%, and that takes you back to 1,001 cents. In other words, at the time that the share reaches 1,112 cents, then your stop loss will be at 1,001 cents, which means that you are then in the money. So I don't know if I've explained that clearly enough, but basically, while your stop loss level is below the price that you paid for the share, you are out of the money, and that is the time when you are most at risk, and that is the time when you must obey your stops for sure, for certain. You must not hesitate to stop out of a share if it falls through your stop loss level when you are out of the money. Once you're in the money, once your stop loss level goes above the price that you paid for the share, you can then afford to widen your stop loss percentage. For example, if you have a share that has gone up 100% from the price that you paid, then you can widen your stop to 15% or 20%, even 25%. But you must make sure that your goal is clear, that your objective is to never lose more than 15% on any share market investment ever. And that should include your dealing costs. All right, so that's just a little bit about how you can cope with the risk in a market like this where you have a major correction which is unfolding. All right, let's have a look at America. The Monetary Policy Committee in America raised interest rates by 50 basis points on the 4th of May. That increase in interest rates was widely expected, and when it happened, it was greeted with great enthusiasm. The Standard & Poor's, the S&P 500 index jumped 3% on the day. This is an interesting situation because what you have there is you have bad news, which is well expected, which is well anticipated. And generally speaking, that causes the market to rally. Similarly, good news, which is well anticipated, causes the market to fall. These are sort of basic understandings of how the share market works. Of course, the Monetary Policy Committee said that future hikes would be limited to 50 basis points in June, July, and August. They also said that quantitative tightening would take place. In other words, they would reduce the size of the Federal Reserve Bank's balance sheet by $47.5 billion per month until September, and then from $95 billion per month after that. Again, this was somewhat better than the stock market was expecting, and that caused the market to rally. Of course, since the 4th of May this year, the market has been digesting the idea that interest rates are now going to rise fairly rapidly in America. That has pushed the S&P down precariously close to its bear trend level. So, in fact, the market almost reached 20%. In fact, intraday, on one day, it did reach 20%. In fact, that day was the 20th of May, when we had what's called a hammer formation. You can see it on the chart on your screen here. There it is, the hammer formation. This is a candle with a very long tail, a long downward shadow, and a short body, and it usually comes at the bottom of a downward trend. So here's your downward trend. There's the record high of 4796, which was made on the 3rd of January. Market's been falling steadily, and then it made a double bottom here, and part of that double bottom was this hammer formation, and since then the market has been rising. You'll also notice here the 300-day moving average. I've put this on because Some investors use the slope on a long-dated moving average, like a 300-day moving average, to determine when the market is in a bull trend or a bear trend. And if you look very closely, you can see that the long-dated moving average, the 300-day moving average, actually dipped down here just briefly on that day, the 20th. But it has now resumed its upward trend. I don't think that this very slight dip here would be sufficient for those investors to think that this was a bear trend. In any event, these types of measures are never certain. I mean, I've been saying since November last year that we would have a major correction of between 10 and 20%, and I said it would take the market down to 3860 on the S&P 500. So now that's happened, and I think that this correction is probably over now, and that therefore what we are looking at is a buying opportunity and not a bear trend. The point is, though, that if you are confident about your ability to sell out on your stops, then you can take the risks which are necessary to make money. You can buy at the bottom of a correction, even though there's a great sense of fear at a time like that. In fact, we would suggest to you that if you don't feel the fear, you're probably not going to make any money. But if you have a 15% stop, then that reduces the fear significantly, and it enables you to take those risks because you know that that's the worst you can lose, 15%. Looking at the economy in America itself, the first quarter of 2022, the US economy actually shrank by 1.5%. GDP fell by 1.5% in the first 3 months of 2022. Ironically, this news caused the S&P 500 to rise by 2.5% because investors took the attitude that if the economy was contracting, the Monetary Policy Committee would not be quite so hawkish. They wouldn't raise interest rates as quickly as they might otherwise have done. But the contraction in the first quarter was caused by a wider trade gap. Imports exceeded exports, and that cut about 3.2% off GDP. This was probably a once-off, and in fact we are expecting growth to resume in the second quarter quite strongly. The US economy is still growing rapidly. It's creating more than 400,000 new jobs each month on average. Economists expect GDP to grow by between 4% and 4.5% in the second quarter, and we agree with them. The fundamentals indicate that the US economy is still growing quickly, and that is the main reason for our continued bullishness. That is the main reason why we do not see this as the start of a bear trend, but rather as a major correction. So we expect the S&P 500 to recover from these lows and in fact to make a new record high, probably before the end of this year. So there's a prediction for you. All right, let's turn our attention now to the South African economy. The impact of rising interest rates all over the world, and particularly amongst our trading partners like the UK and the US, is obviously negative for the South African economy. South Africa's Monetary Policy Committee raised interest rates by 50 basis points, and they did that in order to stay ahead of the curve. Obviously, the differential between the interest rates or the coupon on our 10-year bonds compared to that on US 10-year bonds is important because it offers international investors a real return on their money. And we want to maintain that. So that is why the Monetary Policy Committee increased interest rates by 50 basis points. We can expect more 50 basis point hikes before the end of the year. In fact, we expect the repo rate to reach somewhere between 6% and 6.75% by the end of the year. If it does that, it will be slightly above the level it was at in 2019 before the COVID pandemic began. And interest rates are rising all over the world, and they obviously push the world economy closer to recession. Eventually, rising interest rates will have a negative impact on commodity prices. Fortunately, here in South Africa, the Monetary Policy Committee has managed to keep the inflation rate relatively low, So we are still well ahead of the curve. If you compare South Africa to other emerging economies, you'll see that they're in a far worse condition. For example, inflation in Brazil was 12.23% in April this year. And in Turkey, inflation reached 70% in April. So that shows our inflation rate of 5.9% is relatively benign. The rand remains one of the strongest currencies in the emerging markets. The Monetary Policy Committee expects inflation to peak at 5.9% and then to drop to 5% in 2023 and 4.7% in 2024. Obviously, the floods in Natal have had an impact, and so GDP is now only expected to grow by 1.7% this year. That's down from the forecast of 2% that the MPC made at the last meeting. The Consumer Price Index was 5.9% in April 2022, and it was unchanged from March. So we've had 2 months of inflation at 5.9%. The main contributors to inflation, of course, are food and fuel prices. The impact of the Ukraine war on grains, vegetable oils, and fertilizers is starting to have an impact here, starting to affect the South African economy. And then, of course, there's the question of fuel. The fuel subsidy, which the government has had in place for 2 months, has kept the fuel price under some control, and now they've agreed to extend that for another 2 months. It'll stay the same for this month until the end of this month, and then it's going to be reduced from R1.50 per litre to 75 cents per litre in August. And so obviously they are expecting that the oil price will drop, or possibly the rand will strengthen before then, and so make it possible for them to remove this fuel levy subsidy. Clearly, if petrol moves up substantially, and it is anyway going to go up by R2.33 a litre today, at least between 2.33 and 2.43 per litre, so it will be up substantially today. And that will, of course, have a knock-on effect on inflation. The government has worked hard to try and find ways to soften the blow a bit for consumers. And they have a problem, because if you look at the oil price, let's go to the oil price, and I'll just show you what we're facing here. This is the real problem, and it's not one that can easily be overcome. If you look at the upward trend here, you can see that in the last week or so, in the last 2 weeks really, the oil price has just moved up so strongly. And last night it closed at $123, $124 per barrel, and it's likely to possibly rise even further than that. Fortunately, at the same time, the rand has been strengthening, and so this effect has been to some extent mitigated. All right, moving on from that, Moody's, the international rating agency, has improved its outlook for South Africa to stable. So that's a good thing. But Moody's says that inflation in this country will rise to 8%, which is much higher than the Monetary Policy Committee is suggesting, and it's much higher than most economists here in South Africa, including ourselves, believes will happen. Obviously, the Monetary Policy Committee here cannot stamp too hard on the economic brakes, because the recovery in this country is very tenuous. The second rating agency, the Standard & Poor's rating agency, has also upgraded South Africa to a positive outlook, and they say that our budget deficit is now seen as peaking at about 75% of GDP, which is considerably better than the 95% we were expecting after COVID started. These improved outlooks will obviously reduce the cost of debt and help to encourage overseas investors to come into the country. The latest bout of load shedding, which has gone as high as stage 4, is not helping things. And of course, the ratings agencies are watching to see if the social relief grant is going to continue to be handed out, and whether it will be made permanent eventually. That will obviously impact on the deficit. New vehicle sales in April were down 30% on March, but that is normal for April month because of all the public holidays and so forth. If we compare April to April last year, sales were actually up 4.2%. This year, of course, we had the Natal floods, which did not help. And we also saw that the ABSA Purchasing Managers Index fell to 50.7. It's still in positive territory, but well below March's 60. That's also got to do with the floods and the renewed load shedding. The Treasury has taken over Bloemfontein because of the complete collapse of administration in that municipality. The Constitution in section 139 says that the Treasury can step in to dysfunctional municipalities and take over control to return them to normality. South Africa has got about 257 municipalities, and at the moment about 170 of them are in crisis, and 43 of them are so bad that the Treasury must take control. Dondo Mogajane of the Treasury, he's the Director General there, said that the Treasury cannot actually cope with the problem. There's so many municipalities that need administration. And this, of course, has wide-ranging impact on South Africa, mainly because of the loss of service delivery. And that in turn causes protest action and so forth. The CEO of Score Metals says that South Africa should ban the export of scrap metals from this country because those exports are causing the price of scrap metal to be relatively high, and because it's a high, there's been a lot of theft of scrap metal, which is impacting on state-owned enterprises like Transnet, Prasa, Telkom, Eskom, and others. The direct cost of metal theft in this country is about 7 billion rand. But if you look at the cost to the economy, for example, if railway lines are disrupted or telecommunications are disrupted, it is closer to 180 billion rand per annum. Obviously, a ban on exports of metals, scrap metal, would drop prices, and that would impact on the livelihoods of thousands of bin pickers and other people who make their living out of scrap metal. But the cost to the economy of having things like electricity pylons stolen and railway lines lifted up and taken is much, much greater. Of course, we've had the mining indaba this month, and that is focused on the bureaucratic obstructions to mining in South Africa. Apparently, there is a backlog of 4,500 mining license applications which are waiting for approval at the ministry. This is obviously not a good thing for mining investment in this country. President Ramaphosa says the government might allow 16 rail slots to be sold to third parties, so that might mean that the railway infrastructure is improved because it will come under the private sector, or some of it will come under the private sector. South Africa at the moment is rated amongst the 10 worst countries in the world for mining, according to the Fraser survey. The Treasury said recently that 29,000 civil servants working for the government are earning R1 million a year or more. That was the figure for 2018. And that figure is double the number from 2007. So over that 10-year period, the number of civil servants earning more than R1 million has doubled. The problem is apparently that individual departments have discretion over salary increases, and the Treasury is now trying to standardize pay structures within the government, not including the SOEs, unfortunately. And all of this is being done to try and contain the government wage bill. All right, let's look at the rand, because that is obviously a key component of all these figures. So I'm just going to pull up the chart here. Right, there you go. There's the chart. Put a bit more data on the screen. Okay, here on the left-hand side of the screen, you can see the impact of COVID-19, which sort of peaked there in about May of 2020. And after that, there was a steady trend of strength in the rand, which lasted until the riots in July 2021, and those riots obviously and the civil unrest caused the rand to weaken steadily until November of that year. And then again the underlying strengthening trend came through and reasserted itself. Then we had a double bottom here in April this year, and that was followed by a sharp weakening of the rand as the US Federal Reserve started to stamp on the brakes in America, raising interest rates rapidly in order to control inflation in that country. You can see here that this has caused a double top in the rand, and that after that double top, the rand has been strengthening. So since the idea of rising interest rates in America has been discounted, you see the rand is strengthening because we're moving more towards a risk-on trend, and investors are bringing their money back to South Africa because of the high real rates of return to be had on our government debt. So there we are. The rand is doing relatively well. I think the rand will continue to strengthen. Obviously, that will have an impact on the fuel price, which is a good thing. Okay, so now I'd like to just spend a little bit of time talking about Eskom. The situation at Eskom is becoming perilous. Out of the 38 gigawatts of power which they have available, they had 14.5 gigawatts offline on a single day. A further 4 gigawatts was offline due to planned maintenance. So on that day, they only had half of their available electricity to put into the grid. That, of course, led to load shedding. And apparently there is another 5 gigawatts which is still functioning but which is at high risk at the moment. Pravin Gordhan has said that Eskom has plans for load shedding to go as high as level 8, which means that they will be short of 8 gigawatts. The DA says that Eskom should be declared a state of disaster, and we, of course, believe that Eskom is dying. Slowly, over the years, but it's dying. More and more people are moving away from Eskom. They are finding alternative solutions, and you can see this in a number of areas. Johannesburg, for example, has recently decided to follow Cape Town's example and look for other power sources away from Eskom. So far we've had 15 years of increasingly expensive and increasingly unreliable power from Eskom, and businesses and private individuals are making alternative arrangements. The city of Johannesburg estimates that it could construct a 300 megawatt renewable energy power source for about 26 billion rand. That will take a couple of years, and they will, of course, need funding from the private sector, so they will form a private-public partnership to do it. The gold mine, South Deep, is just about to complete its 50 megawatt solar park. That cost them 700 million rand, but it will generate savings of 123 million rand per annum. So there will be a 5-year payback period. The CEO says that by 2025, the company will get about 22% of its power from renewables. And many other companies are following in their footsteps. So, there's more and more companies are finding that they have to make alternative arrangements for their power. All right, let's look at the companies now. We are always amazed here at how many people still continue to buy unit trusts. It's extraordinary to us. In fact, in the first 3 months of 2022, investors bought about 28 billion rands worth of unit trusts, and the total amount now in collective investment schemes of this sort is over 3 trillion rand. And this is despite the fact that worldwide, about 80% of unit trusts underperform the indexes of the sectors in which they are invested. Since an index is an average, we have to ask the question, why pay somebody to have the virtual certainty of underperforming an average? I mean, this you could do for yourself. You don't have to pay somebody to underperform an average. Theoretically, the chimpanzee in the Pretoria Zoo could do it better. Anyway, it's a source of wonder to us always. Okay, other things coming up in the news. At Sibanye, of course, you know that there's a strike there that's been going on for about 3 months or 3.5 months now. Sibanye has offered an increase which is above the inflation rate, which has been turned down by the unions. But now, the Minister of Minerals and Energy, Gwede Mantashe, has intervened, and he has said that he is considering revoking the Sibanye mining license because he says the Act requires that the mining right must be utilized, and obviously it's not being utilized during the strike. But clearly, this threat sends the wrong message to potential investors in the mining industry in this country. And it's almost insane, actually. So this guy, Gwede Mantashe, is a major impediment to the mining infrastructure in this country. All right, let's look at some shares. First, I'd like to start with a property share, Baldwin. This is a company which develops secure sectional title properties in South Africa. Take this volume off and put a bit more data on the screen. Okay, so you can see here that Baldwin is a share which has been falling for some time. But it's a very good company. And they are now focused on keeping quite a lot of their properties and renting them out so as to increase their income. They're also providing solar power and fiber to their properties, and that also increases their income. The company listed about 5 years ago at 10 Rand, and today it trades for around 3 Rand, as you can see down here. It's down here. But it's got a net asset value of 7 Rand 49, so it's trading at well below half of its net asset value. In its financials for the year to February 2022, headline earnings per share was up 6% on strong sales. So we think this share, trading at 40% of its net asset value, and remember the net asset value here is backed by property, is a really good buy. We think it could be the subject of a takeover bid. Okay, next share I want to look at, Prosus. Now we all know about Prosus and the investment, the 29% of Tencent, which it owns. Tencent, of course, being a Chinese social media and gaming company, which means that the company is exposed to the Chinese economy, which has been subject to lockdowns due to the new wave of COVID over there. It's also subject to the legislation in that country surrounding gaming. And of course, the other company that they've recently had to more or less abandon is Mail.ru, which is their Russian subsidiary. Because of the Ukraine war, Prosus has more or less had to give up on that one for the meantime. But despite all those things, if we look at the chart here, I just want to try and get more data on the screen here. You can see how Prosus a little while ago, on the 19th of February 2021, was trading here for 1,937 Rand. That was on the 19th of February 2021. Since then, it has fallen all the way down to this level down here. So if we zoom in over here, you can see that obviously this is the impact of the war in Ukraine. I've put a 65-day exponentially smooth moving average on here. And what we suggest is that you wait for a break up through that level. And as you can see, that appears to be imminent. The shares found quite strong support here at 690 Rand a share. And last night it closed at 810 Rand a share. But I think it's really cheap at these levels. The net asset value of the company is 109 euros, which is about 1,823 Rand. So you've got a share trading for 800 Rand with a net asset value of 1,800 Rand. So we feel that this share is worthy of your attention at this point. So we recommend that you put on a 65-day exponentially smooth moving average and wait for an upside breakout. All right, the next share I want to look at is Santova. This is a logistics company which has 19 offices in 7 different countries. On the screen here, you can see the top chart here is a standard candlestick chart. The middle chart is an on-balance volume, and the bottom chart is a volume graph with a 30-day moving average running through the middle of it. So what is important about this is that over here, in October 2021, the share gave a strong on-balance volume signal, buy signal, which we reported to you. And it did that when the share price was 425 cents, just over here. It was 425 cents on that day, the 25th of October. Since then, the share has been moving up strongly. And as you can see, it closed last night in the market at 683 cents, which means that it's gained 62% in 7 months. So this shows you the benefit of using on-balance volume as a technique for picking up insider trading. A strong OBV signal indicates that the insiders are mopping up loosely held shares because they know something that the market does not. So we suggest that you follow and watch these OBV signals, especially on relatively small companies which are relatively thinly traded. All right, and then a few of our favorites are doing well and have reported results. Afrimat, you know this company, it's a mining and construction company, sitting at the moment on a price earnings ratio of 11.88 or 12, around about 12. And the results for the year to 28th February showed headline earnings per share up 22.9%. We first recommended this share way back. I can just show you here. Just pull in a bit more data. We first recommended an article here which we wrote on the 25th of May 2020. So it's about 2 years ago. The share was then trading for 29 Rand. Last night it closed at 65 Rand. So the share price has more or less doubled. And in this 2-year period, of course, there have been dividends as well. So this has been a really good share, and I hope that some of you have taken advantage of that. It's gone up 124% in 2 years. And we think it's still good value at these levels. So that's what we're trying to tell you. Transaction Capital. This, you know, is one of our favorite companies, Transaction Capital. They have 3 divisions. They're into minibus taxis. As you know, they basically dominate the Toyota minibus taxis in this country, doing everything from financing them to repairing them and rebuilding them. They're also involved in debt recovery, so they buy up debtors' books and then recover the money. And then the third area of business which they're into is one that they've just got into, where they acquired or they bought We Buy Cars, and they have been doing exceptionally well in that company since they bought it. So the share was listed in June 2021, so it's a while back, and since then it has given a return of 21% compound since it listed. In its results, its latest results for the 6 months to the 31st of March 2022, headline earnings per share were up 38%. So we think this is a low-risk investment which is highly profitable, and it's obviously very, very in tune with the new South Africa in many ways. At the moment, it's at a cycle low, as you can see over here. I'm just going to go back to, you can see here that we're at a cycle low, and we consider that to be a buying opportunity. And then finally, just for those of you who took advantage of our suggestion a while back to buy Lewis shares, it's also one of our favorites. The results came out for the year to the 31st of March. Headline earnings per share jumped an amazing 37.7%. And Lewis is still trading on a price earnings ratio of 6.11. So you're talking about a company here, 6.13. There you can see it right there. It's on a PE of 6.13 and a dividend yield of 6.35%. So it remains excellent value, especially when you consider that this is a company that has got no debt on its balance sheet. I mean, how many big retail operations do you know of in South Africa at this stage after COVID-19 that have no debt on their balance sheet? It's quite remarkable, really. Anyway, I hope that some of you bought these shares and you've done well as a result. Well, folks, that's about all I have for you today. I hope that you found something of value in there. Otherwise, I will be talking to you again on the first Wednesday of next month, July, and I wish you all the best until then.